When you think about a massive financial institution like Wells Fargo, it's easy to kind of get lost in the sheer scale of it all.
Oh, absolutely. Billions flying around, all these different departments. It's complex.
Right, and a constant stream of numbers. So today, we're going to try and, well, pull back the curtain on some of that complexity.
Exactly. We're taking a close look at Wells Fargo's first quarter 2025 quarterly supplement. Think of it like getting under the hood of a car.
Okay.
Not the whole vehicle, maybe, but it shows you the vital signs, how things are running right now.
Right, and yeah, quarterly supplement might not sound like the most exciting title,
Ha! Probably not.
but this document is actually pretty key, isn't it? It's like a more frequent pulse check than the big annual report.
Precisely. It gives us and, our listeners a really timely handle on the bank's financial health. It tells a story if you know how to read it.
And that's basically our mission today then,
Yeah.
to help read that story.
That's the plan. We'll
Yeah.
kick off with the consolidated results. That's the big picture, the overall narrative for Wells Fargo.
The view from above.
Exactly. Then we'll zoom in a bit on their different operating segments, see how each part of the business is contributing, or maybe not contributing as much.
Like walking through the different groves of trees after seeing the whole forest.
You got it.
Okay, let's unpack this. Starting with those big picture consolidated results. This is for the quarter ending March 31st, 2025. First number, total revenue.
Right. Total revenue came in at $20,149 million. That's $20.1 billion, basically.
And how's that looking compared to before?
Well, what's interesting here is it's actually down slightly. It's slipped 1% from the last quarter, Q4 2024.
Okay.
And it's down a bit more, 3%, compared to the same quarter last year, Q1 2024.
So maybe some headwinds there on the revenue side.
Could be, might be broader market stuff, maybe specific challenges in certain business lines. Hard to say just from this one number, but it's a trend.
Makes sense. Okay, now, flip side. Expenses. Non-interest expense was $13,891 million, almost $14 billion. What's the story there?
That figure is pretty much flat compared to the last quarter, basically holding steady.
Right.
And this is interesting, it's actually 3% lower than it was in Q1 last year.
Okay. So revenue's down a bit year over year, but they've also managed to trim these non-interest expenses.
Seems like it could point to some, successful cost management efforts paying off. They're keeping a lid on things.
Okay, that leads us to something called pre-tax, pre-provision profit, or PTPP. $6,258 million. That's a mouthful. Why should we pay attention to this one?
Yeah, PTPP. It sounds complicated, but it's actually really useful. It gives us a cleaner picture of the bank's ability to generate profit from its core operations before you factor in any money they set aside for potential loan losses.
Okay. So it's like their underlying profit engine strength.
Exactly. It shows their capacity to absorb future losses. And the fact that this PTPP number is down 3% from Q4 and down 4% from Q1 last year, well, it suggests that underlying profit engine might be under a little pressure.
Gotcha. Following that logic, next we have the provision for credit losses, $932 million. This is that money they're setting aside for potentially bad loans, right?
That's it, yeah, the buffer. And this provision, it's down quite a bit, 15% from the prior quarter.
15%, wow.
Yeah, and it's also down slightly, just 1% from a year ago.
So what does that mean? They think things are getting better on the loan front.
Well, could be interpreted a couple of ways, really. It might signal they feel their loan portfolio is healthier, less risky, so they need less of a buffer.
Oh.
Or, alternatively, it could just reflect, adjustments in their economic forecasting models. Maybe their outlook changed slightly. It's definitely something to watch in the next few quarters.
Right. So after all that, revenue, expenses, provisions, what's the bottom line? Wells Fargo's net income.
Net income landed at $4,894 million, so almost $4.9 billion.
And how does that compare?
Well, compared to the previous quarter, Q4, it's down 4%. But, and this is important, if you step back and look year over year, it's actually up a healthy 6% compared to Q1 2024.
Okay, so a recent dip, maybe quarter-to-quarter noise, but the longer trend compared to last year is positive.
That's how it looks, yeah. Profitability's up compared to where they were a year ago.
And for investors, the stockholders. Diluted earnings per common share?
Came in at the $1.39.
Okay.
And that trend pretty much mirrors the net income, as you'd expect. Down 3% from Q4, but up a pretty significant 16% compared to Q1 last year.
16% up year over year on earnings per share. That's quite a jump.
It is. And speaking of returns to shareholders, they also declared a dividend of $0.40 per common share this quarter.
Which is up, isn't it? I think it was $0.35 this time last year.
That's right. A
Yeah.
nice little bump for shareholders there. More cash in their pockets.
We also see the number of common shares outstanding.
Yeah.
That's gone down.
Yep, down to 3,261.7 million shares. That's down 1% just from the last quarter, and down a substantial 7% over the whole past year.
And fewer shares outstanding means things like earnings per share get a boost, even when income stays flat, right?
Exactly. It's like slicing the pie into fewer pieces. Each slice automatically gets bigger. Share buybacks doing their work.
Okay, let's talk about the value of those shares, sort of the underlying book value. Book value per common share is $49.86, and tangible book value per common share is $42.24, both up year over year.
Yes, both up nicely compared to last year. These metrics, they really try to get at the net worth of the company on a per-share basis.
Right.
The fact that they're increasing suggests the underlying value relative to the shares out there has grown. And tangible book value, that's the more conservative one, right? It strips out intangibles like goodwill.
Giving a clearer picture of the hard assets behind each share.
Precisely.
Okay, how about efficiency and returns? How well are they actually using all these assets and equity? We've got return on average assets, ROA, at 1.03%, return on average equity, ROE, at 11.5%, and return on average tangible common equity, ROTCE, at 13.6%. How do those stack up?
Well, those key profitability ratios, ROA, ROE, ROTCE, they're all slightly lower than the previous quarter, Q4. But, ROTCE of 13.6%, that's still generally seen as a pretty healthy return on their tangible common equity. It shows how well they're generating profit from their core capital base.
And the efficiency ratio. That tells us how much they spend to make a dollar, right?
Yeah, basically non-interest expenses divided by revenue. It came in at 69% this quarter, which is a slight uptick from 68% last quarter, so maybe a marginal decrease in efficiency during Q1, spending just a tiny bit more to earn each dollar.
Okay. And one last pair from this summary section. Net interest margin on a taxable equivalent basis, 2.67%. And average deposit cost, 1.58%. What do these tell us about the core banking biz?
So the net interest margin, or NM, that's the key spread, right?
Yeah.
The difference between what they earn on assets like loans and what they pay out on liabilities like deposits.
And it's 2.67%.
Yeah, which is actually down just a touch from 2.70% last quarter. So the spread tightened slightly.
But the average deposit cost also went down from 1.73% to 1.58%.
Exactly. That's the interesting counterbalance. The cost they're paying for deposits decreased quite a bit. That decrease could potentially help prop up their net interest margin going forward, depending on what interest rates do. Yeah.
Fascinating interplay there. Okay, let's shift focus slightly to the balance sheet. Looking at the average balances over the quarter, average loans around $908 billion, average assets just under $1.92 trillion. Not much movement there, you said?
Very little change, yeah. Pretty stable on the average loan and asset front.
But average deposits, they dipped a bit.
They did. Average deposits were down 1% from the previous quarter, came in at about $1.34 trillion.
Any thoughts on why deposits might be down?
Could be lots of things. Customers moving money maybe into higher yielding investments outside the bank, changes in savings behavior, could just be normal fluctuation too.
Okay. Now, switching from average balances to the period end, figures the snapshot right at March 31st. We see an increase in both debt securities and equity securities held by the bank. What's that about?
Yeah, that's noticeable. Debt securities rose to about $528 billion. Equity securities up to nearly $64 billion.
So they bought more bonds and stocks.
Seems like it. Could suggest a strategic shift in their investment portfolio. Maybe they saw opportunities in the market, maybe adjusting their risk profile. Hard to say the exact why from just this.
And interestingly, while those securities balances went up, the period-end loans and deposits stayed pretty stable, right?
Yeah, loans ended the quarter at about $914 billion, deposits at $1.36 trillion, very close to where they were at the end of Q4.
One other period-end number that caught my eye, headcount. It decreased.
It did. They ended the quarter with 215,367 employees. That's down 1% from December, and actually down 4% compared to March of last year.
So shedding jobs, efficiency drive.
Could be part of ongoing efficiency initiatives, yeah. Or maybe just aligning staffing with changing business needs. It's a pretty significant drop year over year.
Okay, let's talk capital, those crucial ratios. Common Equity Tier 1, CET1, key indicator of bank strength, right?
Absolutely fundamental. It measures their core equity capital against their risk-weighted assets, shows their ability to absorb losses.
In the numbers.
Under the standardized approach, their CET1 ratio is 11.1%. Under the more complex advanced approach, it's 12.7%.
Both comfortably above regulatory minimum.
Yeah. Both indicate Wells Fargo has a solid capital buffer, plenty of cushion there, and the Tier 1 capital and total capital ratios tell a similar story, good financial strength.
We also see risk-weighted assets, RWAs, listed under both approaches. Can you quickly remind us what those are?
Sure, RWAs are basically the bank's assets adjusted for their riskiness. A super safe government bond gets a low risk weight, a riskier loan gets a higher weight.
Right.
These RWAs are then used as the denominator when calculating those capital ratios like CET1. So the amount of capital you need depends on how risky your assets are.
And did the RWAs change much?
They nudged up slightly under the standardized approach, but actually decreased a bit under the advanced approach. Could just reflect differences in how risk is measured or changes in the asset mix.
Okay. Other metrics here: Tier 1 leverage ratio, supplementary leverage ratio, SLR, total loss absorbing capacity, TLAC, liquidity coverage ratio, LCR. Without going super deep, they all look pretty strong too.
They do, yeah. The leverage ratios, Tier 1 at 8.1%, SLR at 6.8%, show they've got good capital relative to just total assets, not risk-weighted.
And TLAC and LCR.
TLAC at 25.1%, that's about capacity to handle losses in a major crisis. Looks good. And the LCR at 125 means they have 125% of the high-quality liquid assets needed to cover potential cash outflows over 30 days in a stress scenario.
So basically, strong liquidity buffer.
Exactly. All these metrics together paint a picture of a pretty stable, well-capitalized bank from a regulatory standpoint.
Okay, good. Now let's dive back into the consolidated statement of income for a bit more detail. We touched on the top and bottom lines, but what about the middle? Net interest income was $11,495 million. Non-interest income, $8,654 million. How do those compare year over year?
Right. So net interest income, the $11.5 billion, that's actually down 3% compared to Q1 last year, which, ties back to that slightly tighter net interest margin we talked about.
Okay. And non-interest income, the $8.6 billion.
That's basically flat year over year, pretty much unchanged. But when you break that down, that's where you see some interesting moving parts.
Like what?
Well, things like deposit fees, lending fees, investment advisory fees, they all moved around a bit, but nothing too dramatic.
But investment banking fees, they jumped quite a bit, didn't they? Up 24%.
That's a key highlight, yeah. A big jump, 24% year over year. Suggests their iBanking division had a strong quarter, maybe more deal activity, maybe good underwriting performance.
And net gains from trading activities also look strong, at least compared to Q4.
Very strong. Compared to Q4, up 45%, but actually down slightly, 6%, compared to Q1 last year. So good momentum recently, but not quite hitting last year's mark. It's worth mentioning they also had some net losses from debt securities this quarter too, which would be part of that non-interest income line.
Okay. And on the expense side, non-interest expense breakdown. Personnel is the biggest piece, then technology.
Yep. Personnel costs $6.1 billion. They were up 4% from Q4, but actually flat compared to Q1 last year.
Interesting. And tech spending.
Tech, telecoms, equipment, that was about $2.1 billion, down 5% from Q4, and this is significant, up 16% compared to a year ago.
16% jump in tech spending year over year. Wow.
Yeah, likely reflects ongoing big investments they're making in their IT infrastructure, digital platforms, that kind of thing. Occupancy costs also ticked up year over year, though down slightly from Q4.
So, putting it all together, you take all the revenues, subtract the expenses, subtract the provisions, you get income before income tax expense of $5,326 million.
Right.
Then you take out the income tax expense of $522 million. And that gets us back to that Wells Fargo net income applicable to common stock of $4,616 million we started with.
Exactly. It really shows how all those different pieces, the revenue streams, the expense lines, the tax rate, they all fit together to produce that final profit number. It's like a big puzzle.
Okay, one last look at average balances and interest rates. Average rate earned on loans was 5.96%. Average rate paid on interest-bearing deposits was 2.17%. What do these specific rates tell us?
Well, these average rates, when you combine them with the average balances of loans and deposits we discussed earlier, they are the absolute fundamental drivers of net interest income.
Right, the building blocks of the NL.
Precisely. Tracking how these rates change over time gives you real insight into the profitability of their core banking business as the interest rate environment shifts. You can see if they're able to reprice loans faster than deposit costs rise, for instance.
Okay, makes sense. Let's pivot now. We've looked at the consolidated big picture. Now let's look at the reportable operating segment results. Wells Fargo breaks its business down. Why is this important?
Oh, this segmentation is crucial. It lets us see which parts of the bank are really driving performance and which might be lagging a bit.
Because they do different things, serve different customers.
Exactly. Each segment, consumer banking, commercial banking, investment banking, wealth management, they have different dynamics, different products, different sensitivities to the economy. Looking at them individually gives a much more nuanced view than just the consolidated numbers.
Okay, so 5 main segments reported: consumer banking and lending, commercial banking, corporate and investment banking, wealth and investment management, and then this corporate segment. Let's start with the big one, consumer banking and lending. What's in there?
This is the part most people interact with. Checking, savings, mortgages, credit cards, auto loans, basically serving individual consumers and small businesses through branches and online.
And how did this massive consumer segment do in Q1?
Okay, so net interest income was $6.9 billion, non-interest income about $2 billion, for total revenue of roughly $8.9 billion. Right. They set aside $739 million for credit losses in this segment. Non-interest expense was high, almost $6 billion. And the bottom line, net income, was about $1.7 billion.
How's that trending?
Interestingly, both the net interest income and the total revenue dipped slightly compared to both last quarter and Q1 last year. Expenses were also up a bit year over year.
Any bright spots within consumer?
Yeah, actually, mortgage banking revenue showed a pretty significant jump compared to both Q4 and last year, so that part seems to be doing well.
Okay, next segment, commercial banking. Who are they serving here?
This is focused on businesses, generally mid-sized companies, maybe some larger ones too. Think business loans, treasury management services, helping companies manage their cash payment processing, that sort of thing.
And their Q1 results?
Net interest income was just under $2 billion, non-interest income around $950 million. Total revenue, $2.9 billion.
Yep.
Provision for credit losses was $187 million here. Non-interest expense was $1.7 billion. And net income came in at $794 million.
And the trend here, similar to consumer.
Actually, yeah. Similar pattern. Both net interest income and total revenue were down notably compared to both the prior quarter and Q1 last year. Expenses were also up a bit year over year.
Okay, interesting. Now, corporate and investment banking, CIB. Sounds like big deals, big companies, Wall Street type stuff.
That's the one. Advising on mergers and acquisitions, underwriting stock and bond offerings, trading in financial markets, lending to large corporations. That's all in CIB.
And their numbers.
They had net interest income of about $1.8 billion, but a really strong non-interest income of nearly $3.3 billion.
Oh, wow. Non-interest income much bigger than NII here.
Exactly, leading to total revenue over $5 billion. And what's really striking, as we kind of hinted at earlier, is that non-interest income saw a huge jump both quarter over quarter and year over year.
Driven by?
Largely driven by those higher net gains from trading activities and those strong investment banking advisory fees.
Right.
Their provision for credit losses was basically zero. Non-interest expense was about $2.5 billion, and net income was very strong at $1.9 billion. Really the powerhouse segment this quarter.
Definitely looks like it. Okay, fourth segment, wealth and investment management, WIM. What's their focus?
This is about helping individuals, often high net worth individuals and institutions, manage their money. So investment advice, brokerage services, buying and selling stocks and bonds for clients' retirement planning, trust services.
And a key driver here is usually fees based on assets under management, right?
Exactly. Investment advisory fees, asset-based fees, they depend on how much client money they're managing and often how well those investments perform.
So how did WIM do in Q1?
Net interest income was $826 million. Non-interest income, mostly those fees, was just over $3 billion. So total revenue, about $3.9 billion.
Right.
Provision for credit losses was tiny, just $11 million. Non-interest expense was quite high, though, $3.4 billion, leaving a net income of $392 million.
And the revenue trend here?
Total revenue saw a slight dip compared to Q4, but it was actually up modestly compared to Q1 last year. So some positive year-over-year momentum.
All right. Lastly, this corporate segment. What exactly is this? It sounds like a catch-all.
It kind of is. It includes business activities not directly tied to the other main segments. Think corporate treasury functions managing the bank's own funding and liquidity, managing their own investment portfolio, any venture capital or private equity investments they hold, maybe results from businesses they've sold off in the past, stuff like that.
So results here could be pretty variable.
Very variable, often influenced by big picture market moves, interest rates, strategic decisions at the very top, not really operational results in the same way as the other segments.
And the Q1 numbers for corporate.
Well, net interest income was just $36 million. Non-interest income was actually negative $213 million.
Negative. How?
Could be losses on securities, sales, valuation adjustments on certain holdings, things like that. So total revenue was negative $177 million.
Wow.
Provision for credit losses was actually a slight benefit of $5 million, maybe releasing some previous reserves. Non-interest expense was $457 million. And they ended up with a small net income of $78 million, likely due to tax effects or other below-the-line items.
Okay, so corporate is definitely a different beast. Good to understand that breakdown. Let's shift gears again. Focus on credit-related information. This is crucial for a bank.
Right? Absolutely critical. How healthy is their loan book? Are borrowers paying back? Where are the potential problems?
So first, consolidated loans outstanding, broken down into commercial and consumer. What are the big buckets?
Yeah, so period end. Total commercial loans, that's loans to businesses, commercial real estate, lease financing, stood at about $541 billion.
Okay.
And total consumer loans, mortgages, credit cards, auto, etc., was about $373 billion. So a bit more weighted towards commercial lending overall.
And we also see the average interest rates they're earning on these different loan types.
Right. Useful detail. Like the average rate on their total commercial portfolio was 6.28% in Q1. For total consumer loans, it was 5.51%. Those feed directly into that net interest income calculation.
Got it. Now the scary part, net loan charge-offs. What are these again, and what do they look like?
Charge-offs are basically loans the bank has given up on collecting, written off as a loss after trying to recover what they could. It's a direct hit to the bottom line and a key indicator of credit quality.
And the number for Q1?
Total net charge-offs were $1,009 million, just over $1 billion.
How does that compare as a percentage?
That works out to 0.45% of their average loans on an annualized basis.
Is that high, low, average?
It's elevated compared to the super low levels we saw a couple of years ago, but maybe not historically alarming yet. Depends on the context. But the breakdown is revealing.
How so?
Well, when you break it down by loan product, credit cards really stand out. They had a charge-off rate of 4.76%.
Wow, nearly 5% of credit card loans charged off.
Annualized rate, yeah. That indicates a higher level of stress among credit card borrowers. Commercial real estate also had a noticeable charge-off rate, 0.28%.
And by operating segment, where the loss is concentrated.
Unsurprisingly, given the credit card number, the consumer banking and lending segment accounted for the vast majority, $877 million out of that $1 billion total.
Okay, that makes sense. We also have data here on the allowance for credit losses. This is the reserve they build up before charge-offs happen, right?
Exactly. It's the pot of money set aside based on their estimate of future potential losses in the current loan portfolio. It's built up by the provision for credit losses we talked about earlier.
And how did this allowance change in Q1?
It started the quarter at $14.6 billion and ended slightly lower at $14.55 billion.
Why did it go down if they had a provision?
Because the provision for loan losses was $925 million, but the actual net charge-offs were $1,009 million. So the charge-offs slightly outweighed the new provision being added, drawing down the allowance just a bit.
Ah, okay. And how big is that allowance relative to losses or total loans?
Well, the allowance is about 3.4 times the current quarter's annualized net charge-offs, so a decent coverage ratio there, and it represents 1.54% of their total loans outstanding.
And is that allowance spread evenly across loan types?
No, definitely not. The report shows the allocation. For example, as a percentage of each loan class, credit cards have by far the highest allowance allocated, 8.86%. Again, reflecting that higher expected risk.
Okay. And by segment, consumer banking has the biggest dollar amount allocated.
Right. About $7.3 billion of the total $14.5 billion allowance is allocated to the consumer segment, which makes sense given the loan types and volumes there.
Let's talk non-performing assets, NPAs. These are loans that are already in trouble, right? Not just potentially troubled.
That's right. These are primarily non-accrual loans where the borrower is seriously delinquent, usually 90-plus days past due, and the bank has stopped accruing interest income on them. Plus, any property the bank has taken over through foreclosure.
And the total NPA number?
Total non-performing assets were $8.2 billion at the end of Q1. That's 0.90%, so just under 1% of their total loans.
And the bulk of that is non-accrual loans.
Yeah, almost $8 billion of it is non-accrual loans. And within that, Commercial real estate loans make up a really significant chunk, $3.8 billion, almost half of all non-accrual loans.
Commercial real estate again. That seems to be a recurring theme.
It does. It's definitely an area showing signs of stress, which isn't entirely surprising given market conditions, particularly for certain property types.
And the report breaks that down further, doesn't it? By industry for commercial loans and by property type for CRE. Any specific sector standing out in the non-accrual data?
Yes, it does. For the broader commercial and industrial loans, the retail sector seems to have a relatively higher non-accrual rate compared to others.
Okay.
But in commercial real estate, the office property type really jumps out. It has the highest non-accrual loan balance by a pretty wide margin.
The office sector woes we hear about.
Exactly. Seems to be reflected clearly here in Wells Fargo's numbers. Challenges with office space demand, vacancies, impacting borrowers' ability to pay.
Okay. Useful detail there. Moving on briefly to trading activities. The report combines net interest income and net gains from trading. Why look at them together?
It just gives a more complete picture of the profitability from their trading desks, mostly within that CIB segment. It captures both the interest earned or paid on trading positions and the gains or losses from actually buying and selling securities.
And the total for Q1.
Total income from trading-related activities was about $2.6 billion. The net gains from the actual trading part contributed about $1.4 billion of that.
Got it.
Yeah.
Okay, almost there. Let's talk equity, specifically tangible common equity. You mentioned this earlier. It's a non-GAAP measure.
Right. Not defined by standard accounting rules, but very widely used by analysts. You take total common equity and subtract intangible assets, mainly goodwill from past acquisitions.
To get a sense of the hard equity value.
Exactly. The equity supported by tangible assets. At quarter end, Wells Fargo's tangible common equity was about $138 billion.
And that translates to the tangible book value per common share of $42.24 we mentioned.
Correct. And that return on average tangible common equity, the ROTCE, of 13.6%. That's calculated using this tangible equity figure. It's a key measure of how well they're generating profit on that core tangible capital base.
And lastly on this, the report wraps up by reiterating those risk-based capital ratios under Basel III, CET1, Tier 1, total capital. Just reinforcing the message.
Pretty much, yeah. Hammering home that they meet or exceed the regulatory requirements under both the standardized and the advanced approaches. It's all about demonstrating financial strength and resilience.
Okay, wow. We have definitely covered a lot of ground in this deep dive into Wells Fargo's Q1 2025 quarterly supplement. Stepping back from all the numbers, what are the main takeaways or key insights that really stand out to you?
Well, a few things jump out for me. First, while overall revenue dipped a bit, they seem to be doing a decent job managing non-interest expenses, especially year over year.
Okay, cost control.
Second, the real engine this quarter was definitely corporate investment banking. Strong trading, strong investment banking fees really helped lift the overall results.
Right, offsetting maybe some softness elsewhere.
Exactly. Consumer and commercial banking segments looked a little softer on the revenue front. Third, for shareholders, the dividend increase and the continued share count reduction are positive signals. And finally, the credit side needs watching. While the overall allowance looks okay, the charge-offs, particularly in credit cards, and the significant rise in non-performing commercial real estate loans, especially office, those are definitely trends to monitor closely in the coming quarters. Could signal some bumps ahead.
Yeah, that CRE office number really stood out. So for everyone listening, we hope this deep dive has, given you a clearer picture of Wells Fargo's recent performance without you having to wade through the entire dense report yourself.
Yeah, the goal was really to pull out the most significant results, the key trends across the different business lines, and flag some of that important credit stuff.
Exactly. And maybe this leaves you with a question to think about. Given these results, the strong CIB performance, but maybe pressure in consumer and commercial, plus those credit trends, how might Wells Fargo try to position itself strategically now?
That's a great question. Where do they focus their efforts? How do they navigate potentially tricky economic conditions while trying to maximize value? What levers can they pull?
Lots to think about. And if any specific area we talked about, maybe WIM's performance or the details on auto loans or their capital ratios caught your interest, definitely feel free to dig into the original supplement for more detail, or even compare these results to their big bank peers.
Absolutely. There's always more detail if you want it.
Well, thanks for joining us for this deep dive.
My pleasure.